Hi, it's Jerry Kelnan. We have a topic we want to talk about, and when you have that, you ask an expert. So I'm with Sue Ann. And Sue Ann, what's the name of your company?
Turnkey Tax Solutions.
And how long have you had it?
I have been in business for, this will be my 7th tax season on my own. Prior to that, I did tax returns under another company for 3 years. And I've breathed and known taxes all of my life since my mom was a CPA.
Wonderful. Now, our topic today is the MCC, which is a mortgage credit certificate. And one of the things that I like to go into a little bit more is background. I understand you're an enrolled agent.
Yes.
What's the difference between that and a normal tax person?
An enrolled agent is required by the IRS to take 3 very extensive tests understanding the law of the taxes, as well as we are known as America's tax experts. So there are a couple different people that would prepare taxes for you. You could work with an attorney, you could work with a CPA, you can work with an enrolled agent, or you could work with just a tax preparer that doesn't have any credentials. The credentials behind my name require me to take continuing education on specifically tax-related topics. I do education on other topics as well, but as a CPA, I actually do tax returns for CPAs because they're not always versed in taxes. Some of them are auditors, some of them are just in the bookkeeping side, where with an enrolled agent, you're really required to keep that license to understand the tax law.
Okay, so versus an accountant that does accounting, your specialty is taxes.
Correct.
Okay, so now that we've got our background established, let's start talking about the tax credit. So, a brief explanation about the MCC is it's a tax credit instead of a deduction.
Correct.
So, let's touch base on what's the difference between a credit and a deduction.
A deduction is something that reduces your income. So when you do itemized deductions, you can write off your mortgage interest, your property taxes, your sale or your state taxes. Now, the property taxes and state taxes now are limited to $10,000, and our standard deduction for a married couple is $24,400 for the 2019 tax year. On top of that, there are medical, charitable contributions, and a few other miscellaneous ones in there. Where a tax credit is, say after you take all of your deductions off, your taxable income is $25,000 and your tax is $22,500. The tax credit actually reduces the tax dollar for dollar.
Okay, so a deduction reduces the income that you file taxes on.
Correct.
And a credit reduces the actual tax.
Correct.
Okay. Now, one of the things that I hear is when I talk to them about the MCC, well, I don't pay taxes, I get a refund.
That is a misconception most times. There are some tax clients out there that do not pay taxes that only get a refund. But that's usually not your homeowner side of the world. They're usually your lower income single moms, that type of area that they're able to get some refundable tax credits. Most people pay taxes, but when you have your withholdings, you're getting back that amount of money that you paid extra above and beyond. So if your total tax due was $2,500 and you had $4,000 withheld, you're going to get $1,500 back.
Okay.
But that's only really a loan you gave the IRS throughout the year, not really it's a refund, but it's really just a refund of the loan you gave throughout the year.
Right. So in that situation, if they got the tax credit, they would just get a larger refund.
Correct.
Okay. So the tax code change, you just touched on the 24,000 deduction. The MCC was there before the tax code change and it's still there now.
Correct.
What's your view? Is it more or less valuable now than it was before?
I believe it's more valuable now. Not saying it wasn't valuable before, but more valuable now because a lot of people, because the deduction is $24,400 and you're limited on your state and local taxes, so we call that your SALT taxes. So that's your state taxes you pay withholding on, as well as property taxes that you would pay on any properties that you own. It's limited to $10,000, so you got to come up with $14,400 in more deductions than you had before. Or have available, and medical is 10% of your income, so you've got 10%, you gotta get above your 10%, and so unless you're doing a really high charitable contribution, a lot of people are not able to itemize at this point.
But the tax credit still applies even if you don't itemize, the way I
Correct.
understand it. Okay,
Correct.
excellent, excellent. You know, there, in the past have been some other credits for first-time homebuyers. The difference, the way I see it, or the way I like to explain it, is the old credits usually were one time. It was $2,000 or $4,000 or $6,000, whatever it was, and you were done.
Correct.
The MCC is ongoing,
Yep.
as long as you're still the owner occupant of the property.
Correct.
Now, what about if you are under the income limit when you get the tax credit, and then in the future your income goes up and you're over the limit? Can you still claim the credit?
Yes.
Okay.
And it's a carry forward, so if you don't use the credit all in the year that it is available, you are able to carry a portion of that forward.
And you can do that for up to 3 years, right?
Correct.
Okay, excellent. Now, another thing that I've had come up, I did a mortgage for a veteran, and when I was talking to him a couple years later, he said, well, my tax preparer says that I can't claim this credit because I'm not a first-time homebuyer.
That is a misconception as well. As long as you are able to get the certificate, the MCC certificate, you are able to take that credit.
Okay, and so if MCCs are normally for first-time homebuyers and the credit is 25%, but if you're a veteran or you purchase in a targeted area, then you no longer have to be a first-time homebuyer and the credit is 40%. So for veterans, it's really huge. It's a phenomenal benefit for them.
Yes.
And the other thing that I like to point out is it's the federal definition of first-time homebuyer. So it doesn't mean technically you can't have owned a home in the past. It means
7 years, I believe, is it 7?
3.
Oh, 3
Yep.
years. It
Can't-
went, okay.
Can't have had an ownership interest in a primary residence for the last 3 years. So you can even have a circumstance where somebody goes through a divorce. He keeps the house, she moves out. After 3 years, she's not living in it. It wasn't her primary residence during that time. She'd technically be a first-time homebuyer.
Yes.
Okay. Now also, because veterans don't have to be first-time homebuyers, there may be some real good tax advantage if they're thinking of moving anyway to selling their current house and buying another one,
Correct.
because they would be able to get the credit where they're not now.
Correct.
Okay. And one of the other things that I want to stress is the MCC credit can only be done with your initial closing. So one of the most disheartening calls that I get is somebody calls me and says, I heard you do the MCC credit, I'd like to talk to you about it because I just closed on my house. You can't do it then.
Nope.
Has to be right at the time that the closing occurs. So, any other points that you've got?
No, I think that's all of them, but I really think that this credit is going to be a very good advantage at this point, especially with the new tax law, with the itemized deductions being so high.
And one of the things I like to point out is every applicant that I look at their scenario and see if there's any potential for the tax credit. If it's there, I do a worksheet for them and explain. Sue-Ann, if somebody has more questions, could they reach out to you?
Absolutely, anytime.
And what's your phone number?
My phone number is 920-676-2743. They're also able to go right to my website, www.tktaxsolutions.com, and book an appointment. And so if they've got any questions and they just want to sit down and have a conversation, they're welcome to book a 30-minute appointment, and I'll go through it all with them for free of charge.
Wonderful. So again, that was a summary on the MCC tax credit. Sue-Ann is our expert today. I highly recommend her if you're running into the scenario where you're not sure if you would benefit from it or not. Thanks, Sue-Ann.
Thank you.